What if I told you that the world's biggest technological revolution might also be its most expensive illusion? That the so-called $8 trillion AI opportunity, the number plastered across headlines, investment decks, and conference stages, could be built more on excitement than economics. We've seen bubbles before, dot-coms in the 2000s, crypto in 2021, and now AI in 2025. But what if this one's bigger, because it isn't just about a product or currency, but our collective belief in intelligence itself? Stay tuned, because by the end of this video, you'll see why some analysts say the AI boom could reshape global markets and why others warn it might quietly implode before anyone notices. If you trade, invest, or simply want to protect your wealth, this story matters because it reveals where the real opportunities lie once the smoke clears. Let's start with the numbers driving the hype train. According to Fortune Business Insights, the global AI market is expected to reach $294 billion in 2025, up from just $515 million 2 decades ago. Precedence Research forecasts a market worth $3.68 trillion by 2034 with a blistering 19% CAGR. Meanwhile, PwC and Goldman Sachs toss around even larger figures, predicting $15 trillion in global GDP impact by 2030. And right now, almost 9 out of 10 companies claim to use AI in at least one part of their business based on McKinsey's 2025 State of AI report. So if you read the headlines, the story's clear. Everyone's adopting AI, trillions are coming, and missing out could be financial suicide. Every market boom has its language. In the 2000s, it was internet disruption. In 2017, blockchain revolution. Today, it's AI transformation. Venture capitalists are pouring billions into startups that don't even have products yet, just prompts, compute credits, and a dream of training the next big model. In 2024 alone, global private investment in generative AI surpassed $33.9 billion, according to Stanford's AI Index. Big tech is doubling down too. Amazon committed $4 billion to Anthropic. Microsoft sunk another $10 billion into OpenAI. Google restructured its entire research wing under the Gemini brand. Every corporation wants to say it's AI-powered, and that's what keeps valuations and expectations soaring. But here's where things start to bend. Because behind those bright forecasts and billion-dollar press releases, the math quietly stops adding up.
Let's step behind the curtain. Bain & Company recently dropped a bombshell. To sustain the current pace of AI infrastructure build-out, the sector will need $2 trillion in annual revenue by 2030. But the best projections show an $800 billion shortfall. In simple terms, the money expected to fund the AI dream doesn't exist yet. Even inside the corporate trenches, the picture isn't as glamorous. McKinsey's 2025 survey found that while 88% of firms claim they use AI, only 23% have scaled it across operations. Most are still in pilot or prototype phase. That's like calling yourself a professional athlete because you own running shoes. This is how illusions start. When every chart points upward, nobody asks what's underneath. Think of the AI market like a skyscraper built on borrowed optimism. Each new model, each new chip, each new dataset adds another floor. But the foundation is untested revenue, unproven demand, and unsustainable compute costs. The illusion isn't that AI has no value, it's that the value is already here. What we're really buying today is faith. Faith that the technology will monetize fast enough to justify the trillions we're pouring in. But faith has limits. And when the cost of belief runs into the physics of power, chips, and capital, even the smartest illusion begins to crack.
To keep the AI dream alive, we're building digital cities that never sleep. Every chatbot reply, every image generation, every AI trade execution burns through compute power measured in megawatts.
According to Bain & Company's 2025 infrastructure report, data center demand tied to AI workloads is expanding 30% faster than available power grids can handle. The AI supply chain, from chips to cooling, has become an arms race. Here's the catch. AI models are doubling in size roughly every 6 months, yet hardware efficiency improves only about 15% annually. The result? Escalating costs outpacing profit potential. In short, we're chasing intelligence at a burn rate the planet can't sustain. And investors rarely factor that into the trillion-dollar story. If hype had a ticker symbol, it would trade at all-time highs. Take NVIDIA, crowned the first AI infrastructure titan. Analysts now model scenarios of $6 trillion valuation purely on AI momentum. But dig deeper. The same research desks project chip revenue to flatten by late 2026 as supply saturates and enterprise clients delay deployments. Meanwhile, AI-centric startups command valuations that make 2021's crypto scene look conservative. Roughly 60% of new AI unicorns in 2025 report no clear monetization pathway, just potential access to synthetic data or model IP. That's not a business model. That's a wish list with a term sheet. We've seen this movie before. .coms, EVs, NFTs. Each promised infinite growth until gravity returned. McKinsey's latest numbers show the truth beneath the celebration. While nearly 90% of firms claim AI adoption, only 16% report measurable profit lift. And when Bain modeled energy and compute requirements versus projected revenue, they found a paradox. Even if every Fortune 500 company scaled AI successfully, cumulative ROI might hit just 40 cents on the invested dollar before 2030. Translation? Many will spend billions modernizing workflows for marginal efficiency gains. That gap, the one between cost and captured value, is where illusions thrive. It's not fraud, it's momentum without measurement. Every bubble needs a narrative. For AI, it's automation of everything. Behavioral economists call it narrative reinforcement when investors ignore weak data because stories feel inevitable. Case in point, between 2023 and 2025, global venture funding fell 28% overall, but AI investments rose 22%. Why? Because no one wants to be the executive who missed AI. That fear of irrelevance fuels a spending spree detached from fundamentals. In Wall Street boardrooms, CFOs whisper the same line: "We can't afford not to invest." That sentence built the housing bubble, inflated crypto, and now it's underwriting AI. Beyond hype and psychology lies the cold math of supply. Semiconductor lead times still average 35 weeks even after record production. Energy analysts warn that AI-driven data center demand could consume 10% of U.S. electricity by 2030, triple today's level. Meanwhile, talent bottlenecks persist. Global demand for AI engineers exceeds supply by 4 to 1. Wages soar, margins shrink, projects stall. So when someone says AI will add $8 trillion to the world economy, ask with what power, what chips, and whose talent? Because the numbers don't yet align. And that misalignment, the gulf between potential and practicality, is where smart money starts planning exits while the crowd keeps buying the dream. So, is the $8 trillion number a lie? Not exactly. It's a projection, not a promise. A blend of potential GDP impact, software sales, and indirect productivity gains. Here's the truth few say aloud. Most of that figure, roughly 80%, is economic ripple effect, not direct corporate revenue. Realistic forecasts peg the AI market closer to $1.7 to $3.6 trillion by 2034. Still massive, but far from 8. That means investors chasing the $8 trillion AI boom are betting on second-order effects,
power grids, semiconductors, data infrastructure, rather than the algorithms themselves. The illusion isn't in the technology, it's in how far its economic gravity is assumed to reach. Every gold rush ends the same way, with consolidation. In the next 24 months, expect a wave of M&A, smaller AI startups absorbed by cloud giants, niche data firms bought out, and mid-tier providers vanishing altogether. Bain projects that by 2027, the top 10 players will control 75% of AI infrastructure spending. For retail investors, that means the broad AI basket becomes a high concentration game. The winners grow faster, but the losers disappear overnight. So how do you navigate that power shift without becoming collateral damage?
Here's the framework used by institutional money. The same desks quietly rotating capital while social media screams AI to the moon. Step 1. Follow the picks and shovels. The real gold in any boom isn't in the nuggets, it's in the tools. Track companies supplying chips, cooling tech, and energy efficiency systems. If AI is the mine, these are the miner suppliers. Step 2. Measure real adoption. Skip vanity metrics. Ask, how many firms are paying for scalable AI, not just experimenting? Step 3. Track unit economics. The next crash will come not from failed models, but from failed margins. When compute costs outpace ROI, valuations will compress. Step 4. Stay nimble. This market moves in hype cycles. Build positions in phases, take profits early, and keep dry powder for dislocations. The next 18 months may bring an unexpected twist: AI inflation. As compute demand spikes, hardware scarcity can drive prices higher across tech supply chains, affecting indexes, even foreign exchange flows. For traders, this is critical. Tech-heavy indices like the Nasdaq and Nikkei act as barometers for risk appetite. When AI sentiment peaks, global capital rotates, often pulling currencies with it. In short, AI hype isn't just a stock story, it's a macro wave. And if you can read its rhythm, you can trade the world's emotions in real time. Here's the paradox. Even if the bubble deflates, AI itself will not die. The internet didn't vanish after the dot-com crash, it matured. Crypto didn't disappear after 2022, it evolved. The same fate awaits AI. After the speculation clears, what remains will be infrastructure, embedded, invisible, indispensable. The true builders will keep working while everyone else moves to the next shiny thing. That's when the real money arrives, quietly, after the headlines fade. So when you hear $8 trillion, remember, hype multiplies faster than hardware. But understanding where illusions form gives you an edge most traders never see. The winners of this cycle will be those who read data, not drama. If this deep dive opened your eyes, hit that subscribe button, because in my next upload, I'll reveal 3 under-the-radar sectors quietly profiting from the AI gold rush without touching a single algorithm. Don't chase the mirage. Learn where the tide actually turns.